August 26th. One date, one stock. And honestly, quite possibly the single most critical market-moving earnings report of the entire year. Welcome to this explainer. I am absolutely thrilled to walk you through this today because what we are looking at right now is a defining moment for the market. Whether you're an investor already holding Nvidia, maybe you're just watching from the sidelines, or even if you're looking to short it, this is exactly where you need to be. We're going to break down the data, strip away all that noise, and look at exactly what is happening under the hood. Just take a look at this number. $300 billion. Let that sink in for a second. As we approach this earnings report, the options market is currently pricing in a 10% swing in Nvidia stock. And because of Nvidia's massive size, well, that 10% translates to over $300 billion in market cap moving in a single trading session. To put that into perspective for you, that's the equivalent of an entire mega cap corporation literally being created or totally wiped out in a matter of hours. The stakes absolutely could not be higher. So, to navigate an event this massive, here's our playbook. 1. The AI barometer. 2. The bull case. 3. The bear case. 4. The smart money. And finally, 5. The actionable playbook. Let's jump right in. Section 1. The AI barometer, and why this earnings report matters so much. We've got to establish the context here, because Nvidia isn't just another tech stack anymore. It is the absolute anchor for the entire market's AI revolution. You know the saying, when Nvidia sneezes, the entire NASDAQ catches a cold. Now, over the past 4 quarters, they've delivered stunning triple-digit data center growth, but compounding math is a harsh reality. Now, what's really interesting about this slide is the gap between expectations. Official Wall Street consensus revenue sits right around $30.5 billion. But check out the whisper numbers coming from hedge funds. They're pushing closer to $32 billion. This perfectly illustrates why merely good growth might actually trigger a sell-off. If Nvidia prints $31 billion, sure, it beats consensus, but it misses the whisper. The stock could sell off on a report that's good, but just not great enough for that institutional appetite. But actually, scratch that. The true make-or-break number is their Q3 guidance. The market desperately wants to see them guide for at least $33 billion moving forward. Anything less than that $33 billion mark, and we are staring down the barrel of a potential 10 to 15% drawdown. Make no mistake, the market is pricing in absolute perfection right now. Okay, let's dive into this. Section 2, the bull case. Why Nvidia could completely soar. The bullish narrative here argues that despite the massive run-up we've seen, the AI boom might truly only be in the second inning, and Nvidia currently owns the only bat. There's a clear triad of bullish catalysts happening right now. Step 1 is the Rubin chip timeline. Rubin is Nvidia's next-generation AI platform, and rumors are swirling that it might start shipping earlier than expected. If management even hints at strong pre-orders stretching into 2027, that forward visibility acts as a massive multiple expander. Step 2, enterprise AI adoption. For 2 years, this was just about Amazon, Google, and Microsoft. Now, mid-size enterprises are deploying AI. It's a whole new layer of demand that wasn't even priced in 6 months ago. And step 3 is the supply chain. TSMC's CoWoS packaging capacity is finally catching up. More chips shipped equals more revenue recognized. So if these 3 factors align and push guidance above that $33 billion, bulls argue this stock could easily gap up 6 to 8% overnight. Flipping the coin, let's look at Section 3, the bear case, the hidden landmines. Skeptics argue that the easy money in AI has already been made. When a stock trades at this kind of historical premium, those valuation models leave absolutely zero room for error. The first major risk here is margin compression. Nvidia's gross margins have been hovering at an incredible 75%. That's essentially peak performance. But as the AI market matures, Nvidia is starting to sell more inference chips compared to their highly lucrative training chips. And inference chips simply carry lower margins. If management guides gross margins down by even a single percent, those pristine valuation models, they start to break down real fast. The second massive risk to keep an eye on is customer concentration. Check this out. Over 40% of Nvidia's data center revenue relies entirely on just 5 mega-cap tech giants. We're talking Amazon, Google, Microsoft, Meta, and Oracle. That is a wildly precarious position to be in. If just one of those 5 companies decides to, pause their capital expenditure spending, it instantly blows a multi-billion-dollar hole in Nvidia's revenue projections. And the third and final pillar of the bear case revolves around China. Export restrictions on high-end chips are tightening globally. Bears are listening very closely to this upcoming earnings call for any mention of potential new compliance costs or lost regional revenue from the Chinese market. Any hint, literally any hint, of geopolitical headwinds creates an immediate overhang on the stock. To the bears, this is purely a show-me story now. Section 4. The Smart Money. Let's decipher the options market. We've heard the stories, but what is the smart money actually doing? Let's take a peek behind the curtain to see how institutional hedgers are deploying their capital ahead of the print. We start by looking at the at-the-money straddle. For those just learning the ropes, a straddle is an options pricing strategy where traders buy both a put and a call at the current price. Right now, this strategy is implying a massive 10% move in either direction. That means the smart money expects the stock to violently reprice to somewhere between $120 and $140 per share immediately post-earnings. They are bracing for extreme volatility. But when we dig a little deeper into that options flow, a very specific picture emerges. We are seeing rising put volume completely outpacing the lagging call volume. Over the last 3 days, institutional investors have been heavily buying downside protection rather than making bullish directional bets. This reveals a slightly bearish skew. Now, it doesn't guarantee the stock will drop, but it absolutely means hedgers are experiencing some elevated nervousness right now. Which brings us to Section 5, the Actionable Playbook, strategies for every investor. We've got the context, we know the risks, and we see exactly what institutions are doing. So let's deliver some direct, scenario-based strategies derived straight from the data we just analyzed. Depending on your specific profile, the playbook completely changes. If you are already long, this is actually the hardest position to manage. The data suggests trimming 5 to 10% before the print to lock in profit, just because the risk-reward is skewed right now. If it runs, you still win. If it drops, you buy back cheaper. Now, if you want to buy in, do not go all in before the release. Take a small 25% starter position and set a limit order 8 to 10% below current levels to catch a classic post-earnings shakeout. And if you're a short-term trader, well, the data heavily points toward executing an iron condor. Let's quickly define that iron condor for our viewers who might be newer to options. An iron condor simply involves selling out-of-the-money puts and calls to collect the premium. You're essentially betting that the stock's massive expected move stays neatly contained within that $100 to $140 range we talked about earlier. It's not a grand slam home run swing, but it is a highly structured, high-probability trade designed specifically to take advantage of the elevated volatility during a massive binary event exactly like this one. Whatever strategy you align with, this is the moment of truth. Mark your calendar for August 26th at 4 p.m. Eastern Time. Have your trigger set and get your orders ready before the market closes. Nvidia is undoubtedly the most important stock in the world right now. It's literally acting as the fulcrum for the entire S&P 500. But always remember, while the short-term volatility is going to be intense, no single earnings report changes the fundamental long-term AI thesis. We've looked at the whisper numbers, the margin threats, the bullish catalysts, and the institutional hedging. You've got the data, and you've got the strategies. So I'll leave you with this provocative question as we head into the close. What is your playbook for the $300 billion AI barometer? Analyze your risk, pick your strategy, and trade smart. Thank you so much for joining me on this explainer. I hope this leaves you focused, equipped, and incredibly ready for Wednesday afternoon.